Hey fellow investors, this is Charlie Tian again. Very glad to be back. Last time I talked about the Shiller P ratio. I mentioned that it's a better measure of valuation of stocks and the general market and the sectors sometimes. Today I want to talk about very basic concept of P ratio. So what is a P ratio? A P ratio is actually very simple. A P ratio is the price divided by earnings. So if you pay $15 for the stock, and the company is earning $1 per share, and the period is 15. It measures how many years for you to get your money back based on the company's earnings. So obviously, the lower the P ratio is, the better, because the quicker you get your money back. The advantage of P ratio is you can compare different businesses across different industries with a P ratio. And the only measure there is how many years you get your money back. Obviously, if the business is growing faster, it deserves a higher PE because you get your money back faster if the company grows faster. Sometimes you see a concept of forward PE. Forward PE means the current price divided by the next year's earnings. So if the forward PE is lower than the PE, it means the company is growing its earnings. If a forward PE is higher than its PE ratio, means company's earnings is declining. Something you need to be careful about PE ratio. First, I mentioned that PE ratio, the lower the better, but it cannot go negative. If a P ratio is negative, it means the earnings is negative and you're losing money, and you can never get your money back if a company continues to lose money. And that's the first thing. And second, sometimes a one-time earning can distort the P ratio. A company may have a higher one-time earning at some time, and the P ratio can be artificially low, which is actually deceiving. And third is P ratio does not work well for cyclical companies. For instance, a company here, Southwest Airline, we're all very familiar with the company, and this is a stock price here. And currently, of course, it dropped a lot due to the coronavirus. If I shrink it a little bit for 15 years of data, look at this chart. And this is a price chart. And now if I want add the P ratio onto this chart, and you will see that this is a P ratio. This purple line is a P ratio of Southwest Airlines. It goes wild historically. And during the financial crisis, 2008, 2009, the company was losing money, earning became negative, so the P ratio became negative. Before and after that, the P ratio were both very high because the company wasn't making as much money as it was before the financial crisis. And you can see that the period sometimes goes much higher, sometimes suddenly it goes lower, but not because of the price change, but because the earnings of the company is not stable. So the P ratio is actually a very good measure if the earning is predictable and stable. It works for stable companies. It doesn't work well for cyclical companies. Again, you need to be careful about the one-time thing too. That's about P ratio. Next time I want to talk about PS ratio, which is price to sales ratio, which is a better measure sometimes. And stay tuned. If in the meantime, if you have any questions, comments, please leave it in the comment area. I'll get back to you as soon as possible. See you next time.